Welcome back to the channel. Last week, I've discussed about what's new in 2025, focusing on ATO's upgraded reporting tools coming into effect from July. In this video, we'll walk through some details in regards to what counts as rental income, which expenses you can claim immediately and which must be depreciated, how to handle co-ownership and partial private use, capital gains tax when you sell. First up, rental income. According to the ATO, rental income is more than just the weekly rent. It includes rent payments from tenants or short-term guests, Airbnb and other platform earnings, bond money you keep, such as when it covers unpaid rent or damages, insurance payouts, for example, if you claim for lost rent, reimbursements from tenants for expenses you initially paid. The big update for 2025 is that short-term rental data, like Airbnb or stays, will be directly reported to the ATO from July 2025. That means if you rent your property even for a week, it must be declared. Now let's talk about something interesting: deductions. Rental property expenses split into three groups. Number one, immediate deductions. These can be claimed in full in the year you incur them. Some examples are interest on investment loans, property manager fees, council rates and insurance, repairs and maintenance, but only for wear and tear, not improvements. Number two, capital works deductions. This covers construction costs and structural improvements. You can't claim them all at once. Instead, you generally deduct them at 2.5% per year over 40 years. Number three, depreciating assets. Things like ovens, carpets, or furniture. These decline in value over their useful life, and you claim deductions based on ATO's effective life tables. Here's the common mistake: claiming renovations or initial repairs as immediate deductions. If you replace a roof or remodel a bathroom, that's a capital improvement, not a repair. Travel expenses rule. A lot of landlords still get this wrong. Since 2017, individuals can't claim travel expenses related to residential rental properties. That means no deductions for flights, car trips, or accommodation when inspecting your property. The only exception is if you're running a rental property business at scale, or if you hold the property in a company or certain trust structures. If you co-own a property, rental income and expenses must be split based on legal ownership. So if you and a partner own a property 50-50, you can't just decide one person claims 80% of the deductions because they earn more. It must be split according to the title deed. If you use the property for private purposes, say you stay in your holiday rental for 2 weeks, you must apportion expenses so only the rental use portion is claimed. The ATO stresses that you need to keep records for at least 5 years. This includes rental agreements and statements, loan documents, invoices and receipts for expenses, depreciation schedules, and building cost reports. From 2025, the ATO expects more landlords to use digital record-keeping tools. That makes it easier for them to cross-check data from banks, property managers, and online platforms. Capital gains tax, CGT. When you sell a rental property, you need to consider capital gains tax. Your capital gain is simply difference between what you paid for the property, plus buying costs, and what you sold it for, minus selling costs. If you've held the property for more than 12 months, you may be eligible for the 50% capital gains tax discount. If the property was your main residence for part of the time, you might get a partial exemption. But the ATO warns that many landlords forget to adjust their cost base for depreciation claimed, which increases their capital gain. Here's some common pitfalls for landlords: forgetting to declare short-term rental income, claiming private expenses as rental deductions, misclassifying renovations as repairs, not apportioning deductions for partial private use, ignoring insurance payouts or bond money. From July 2025, with direct reporting from agents and platforms, these mistakes will be automatically flagged. In 2025, there will be stronger data matching programs for rental income, with Airbnb and property managers reporting directly to the ATO from July 2025, and there are clearer rules around apportionment when a property is partly private and partly rental. This means the days of relying on honor system reporting are ending. But the good news is, if you're organized and declare everything properly, there's nothing to fear. And you'll maximize your deductions along the way. So start preparing now, especially with the new reporting rules coming in from July 2025. That's the wrap for today. Thanks for watching. If this video helped you understand your rental property tax obligations, hit subscribe for more updates on property, investing, and Australian tax changes. Have a good one.